The dividend valuation model is a model used to estimate the cost of equity based on the dividends expected from a share bear growth. The key elements of this definition include the dividends, the share price, and the constant growth rate of dividends, making up the formula displayed on screen. The underlying assumptions under the dividend valuation model in estimating the cost of equity are as follows. The first assumption is that the model is based on the principle that the market value of a share equals the present value of all expected future dividends. Second is that the model assumes that dividends grow at a constant rate forever, and this assumption is based on the Gordon growth model. Third is that the model assumes existence of a perfect capital market, where there are no transaction costs, there are a large number of buyers and sellers of shares, no individual can affect the share price, and all investors have all available information. Fourth is that the model assumes that investors value shares based on the dividends they expect to receive rather than the capital gains alone. The final assumption is that the model assumes that a company has a stable dividend policy. This does not apply where the company does not pay dividends. Let us look at an illustrative example on how to calculate the cost of equity using the dividend valuation model. Based on the information as per the illustrative example displayed on screen, we are required to estimate the cost of equity. To estimate our cost of equity using the dividend valuation model, we have to first determine our variables, which include the share price, the annual dividend, and growth rate. As per the scenario, we are given our share price at a market value of $2.70 each, the dividend at $0.2 for the last 10 years, and growth rate at 5%. Kindly take note that the share price used must be ex-dividend, meaning that the market value of the share price must be after a dividend has been paid or declared. This scenario specifies that the company is about to pay a dividend of $0.2 per share as for the last 10 years, implying that the share price is cum dividend. The fact that a dividend is about to be paid evidences that the dividend has been declared. So we have to strip out the 0.2 first from the share price at $2.70, get the ex-dividend share price of $2.50. The next step will be to divide this annual dividend of $0.20 with our given share price of $2.50 to get 0.08. If we add the growth rate of 5% to the 0.08, we get 13%, and this becomes our cost of equity. Let's move on to the estimation of the dividend growth rate under the dividend valuation model. There are two ways of calculating the dividend growth under the dividend valuation model: the historical dividend growth model and the retention growth model. Let's look at these in detail in the next video.